Hello and welcome once again to the Smart Money, Dumb Money Show. I'm your host, Keith Richards. I am President and Chief Portfolio Manager of Value Trend Wealth Management. And today is January 4th, and I'm going to talk to you a little bit about the dogs of the Dow Theory and how we might improve our odds of success by picking stocks out of that list. I'm going to just share with you a PowerPoint presentation that will help you understand how the dogs of the Dow Theory works, how it's performed over the long run, and why it can be used for creating a list of stocks that you might want to take a look at and consider for your possible investment analysis. Now, the theory does involve using all 10 or 5, and I'll explain how this works in a minute, but all 10 or 5 of the stocks that come up at the end of every year by using their screening criteria. And all you do is you buy those 5 or 10 stocks, and then you hold them for the year, and then you replace the stocks that are no longer on the list the following year. And if you do this year in, year out, it has actually performed better than the Dow Jones Industrial Average over time. So let's see how it works. I'm going to go right to the PowerPoint, and I'm going to start off by giving you an idea of how the dogs of the Dow 10 have performed. And again, I'm going to explain the difference between the 10 and the 5. I want to talk to you about how the 10 have performed over the past 20 years, well, 23 years really, since the year 2000, and then how the dogs have performed by using the small number, the small dogs it's called, which is 5 stocks. So if we look at the Dow 10, the dogs of the Dow 10, since 2000, it's made an annualized return of nearly 10% even, 9.9% to be exact. And that's to the end of 2023, just a few days ago. If we look at the small dogs, as they call it, which is, as I'll explain in a minute, the lowest price of the 10, lowest price stocks of those 10 stocks, it's actually done better than the 10 by performing at 12.1% on average since 2000. So this is pretty good because the Dow Jones Industrial Average itself only performed at 7%, as you can see on the slide. But a couple things I want you to remember is that in some years, the dogs of the Dow strategy underperforms, and we're going to look at that in the last slide today. And in fact, there's been a couple times where there's a string of years. So it's a good way of looking at stocks, I think, for searching for value, but I do think we need to further refine it a bit. Now, the data I just gave you is courtesy of dogsofthedow.com, and that website's been around forever. So you can go there, it's dogsofthedow.com, and they have all their statistics and tell you the exact stocks they're buying every year and how they're doing and all that wonderful stuff. So how the dogs of the Dow are created is the 10 highest yielding stocks at the end of the year close are taken out of the Dow 30, and they're called the dogs of the Dow. That's the 10. So the last trading day of 2023 was December 29th. So we're going to look at the 10 highest yielding stocks, and we're also going to look at the 5 lowest priced stocks of those 10, and they're called the small dogs. Okay, so let's look at the 10 stocks, but I want to look at them with an eye on their charts, because I'm a believer that if we go into a bearish market, we may end up in one of these years where the theory may end up being an underperformer, as it has a few times through history. So let's take a look at the next slide, which is the list of these 10 stocks. And you'll notice I've got on the left side the symbol, then we've got the stock name, the year-end price, the year-end yield, and then whether they are small dogs eligible. And that's what that basically means is, are they the lowest price of the 10? Okay, the 5 lowest price stocks. So you can see there's some big names on the list. That's because it's Dow stocks. And we want to now look at the first 5 stocks, which are the lowest price. So that's the small docs, the lowest price list of 5 to start off with. So we'll go to the first chart, which is Walgreens. And if we look at this chart, you can see certainly it has had a bit of a struggle, as by the way, so has a competitor, CVS, which is not on the list, but is worth mentioning. You can see Walgreens is trying to base, I didn't draw lines on this, but you can see at the bottom, there's a cluster through the latter quarter of 2023. It rallied strong in December, along with that stock market rally, but it has pulled back sharply to what might be a neckline. So my thoughts on this chart is I would want to see if this neckline is going to hold before I bought. But it's an interesting looking bottom formation. It might work out to be okay. All right, next of the 5 cheapest stocks is Verizon. And you can see it's just coming into resistance. So you can see there's a level somewhere right around where it is right now, around 40 bucks. It needs to penetrate that, but it has lots of upside if it does manage to penetrate it. Okay, the next of the 5 lowest price stocks is Dow Holdings and Dow Chemical. And you can see that Dow Holdings, DOW, on the US markets, has been pretty sideways since 2021. It's been very range bound. And you know me, I like sideways stocks. I like stocks that go up and down in a range. This certainly does seem to have a range from around $45, $46 on the low end, and it seems to top out somewhere in the 55 or so level. Not a bad range. It's near the top of that range, as you can see right now. I don't know that I would buy this stock right now. Another example of a similar range-bound stock is Coca-Cola, and you can see it's approaching its top of its range, which lies around 63. So again, this is one I'd probably, at this point, be crossing off the list. Even though we may see $2 or $3 more on the stock, I don't think it's worth making 5% on Coca-Cola if it's going to find that same lid that it has discovered many times since 2022. All right, Cisco Systems, tech stock. It's funny, when I was early in the business, I've been doing this since 1990, so I'm now in my 34th year of doing this. And I was a stockbroker in the bad old days. I'm a portfolio manager, of course, now, have been for several decades, but my first at least 10 decades in the business, or 10 years, I should say, in the business, I was a stockbroker and investment advisor, and I had a client, and we were buying and selling Cisco way back when. This would have been in the late 90s. And he didn't understand that the stock's name was actually Cisco, even though I kept correcting him. And he called it Crisco, just like the lard that you cook with. So Crisco, or Cisco, call it what you will, does seem to be in a little bit of an uptrend, higher highs, higher lows. This old high is going to have to be taken out, but it might actually have a chance of rallying back to that high. So maybe this is one I would consider on the list. Here's another interesting one. So I think we're out of the first 5. We'll now start looking at some of the ones that are in the higher prices. And 3M. Now, this is a name that's been around a long time. In fact, most of the Dow stocks are or have been around for a long time. Actually, I think this is our 5th. Let me count. 1 or 5. This is our 5th. Sorry, this is in the low priced 5. So 3M has been in a downtrend, and you can see, if I were to draw a trend line here, it's attempting to break that downtrend. You can see there's quite a bit of resistance here. That might be a lid. You can see it kind of goes right across at around 105. It's just barely breaking that right now. And in fact, there's some trouble up ahead at around 110, which is where it is right now. If 3M breaks 110, I'd actually think that this is a pretty darn good looking chart. So it needs to break the 110 definitively for multiple days before I get too excited. But the break of a downtrend is always a good thing, and it's definitely looking like it's trying to do that. So I would really keep an eye on 3M. So now we are definitely out of the low price 5, and we're into IBM. It's interesting how this stock made the list, but I guess it's to do with the yields. And IBM is definitely not in a downtrend. It was in a gently rising trend, and then I guess because of their involvement with AI and all that stuff, they've had some upside over the past quarter. First, sorry, I should say last quarter of 23. It's a little overbought. You can see that with all the white candles. There's a level of old resistance that it broke there. This is a very good chart. I would think it would pull back a bit, but I think IBM should be watched for a pullback. It might be a very, very good stock to buy. Okay, Chevron, good old gas company, oil and gas, and they're in one of these trading ranges since 2022. Again, you know the drill. I like buying and selling within ranges, but not necessarily buying and holding. So somewhere around the $140, which is pretty close to where it is right now, is not a bad buy point, and then a sell point is around 170 to 175. So that's a trader, and it's probably an okay stock to take a look at. Again, you should do your fundamentals on these stocks. I'm strictly looking at the charts. Now, Amgen, it's broken out. That's a pretty clean looking chart. That was an old lid there around 280. It broke, big white candle, may pull back a bit, but generally speaking, all-time highs, breakouts are very, very good. So that's definitely one that I would be taking a look at. And Johnson & Johnson. Now, Johnson & Johnson is a sideways looking chart, but my problem with this chart is that its most recent low broke a last significant low, which was lining up with other lows really since 2021. You can go way back here. And that low point used to be somewhere around 150 bucks. It actually reached about 140 something. So it does seem to be trying to rally back. It might be an interesting one to play up to 170 or so, 170, 175. But there's a little more risk on this one, so it's probably worth taking a look, but keeping in mind that you will want to do your fundamentals on this before you bought it. All right, so that's the list. That's the 10 stocks. There was a couple in there that I didn't mind at all. So I want you to keep in mind that the dogs in most years outperform the index. So that's a good reason why we should be looking at these stocks in our list of ideas. But they don't always outperform. For example, last year, 2023, they underperformed by quite a bit compared to the Dow Industrials Index. Other examples, there's many examples actually. If you go to that website I told you, you can see the years that it's underperformed, but 2017, 19, and there was even kind of a prolonged period between 07 and 09 where they did not outperform. Doesn't mean they went down, but they did outperform. So the dogs, in my view, are not necessarily something that we should do every year and do the dogs of the Dow 10, especially because if we enter into a period of sideways markets, I sometimes wonder if strategies like this will work, because I think you have to be much more nimble in your buying and selling strategy. But whatever the case, they can provide a very good list of value ideas for us to be looking at, because these are stocks that have high dividends, and often that's because they've been depressed a bit. You saw that on a couple of them in the list we just looked at. So if we use technical analysis, we can refine our picks a bit, and we can become more of an active manager surrounding the dogs of the Dow strategy. So in other words, rather than just buying the 10 or buying the 5 and then holding them for the entire year with no regard to the market, we can actually technically trade them and at least increase our safety of the markets not rewarding this strategy in the same way it has in many other years. All right, so I hope that helps. And for future reference, you can look at that website, Dogs of the Dow. And any questions on your portfolio, you can come to valuetrend.ca and hit the contact button, and we'll be happy to talk to you about how we might help you manage your portfolio as effectively as we do for our clients. We've had 2-year numbers that are pretty good. We've made money in the past 2 years since the markets peaked back in early 22, and markets have basically been dead flat or down since that period. The S&P, as you probably know, hit a peak of around 4,800 early 22, and the TSX, I think, hit 20,800, if I'm not mistaken. Neither of those levels, sorry, actually it was 22,000 for the TSX, and neither of those levels have been cracked, whereas the value trend equity platform and the aggressive platform both have higher levels today. So thanks for watching, and we'll see you next time.